Chapter 1, the investment environment. We are going to hit a couple of different topics to really define some fundamental points for our discussion of investments going forward. So we'll hit a couple of different things. We'll bounce around a little bit in this chapter to make sure we cover these sort of basic points. So first, we're going to talk about real assets versus financial assets. Property, plant, and equipment, which are things that firms use to produce goods and services, and we call these real assets. And then the claims among investors that define the allocation of profits or of wealth from these real assets. And so for a commercial firm's perspective, real assets are balance sheet assets. They are things that the firm owns and uses to produce income. And financial assets are balance sheet liabilities or owner's equity. Financial assets can be held directly by investors or through financial intermediaries or by financial firms. And so from a financial intermediary's perspective, financial assets are actually balance sheet assets. And balance sheet liabilities and owner's equity are claims on these assets. And so to look at a couple of different balance sheets here, we have a commercial firm. Its assets are short-term assets, cash, accounts receivable, and inventory. And its long-term assets are essentially property, plant, and equipment. There can be other things. This isn't an exhaustive list. But again, we just want to define these real assets and then the financial assets, which are on the liability side. And so we have bonds and stock. Over here for a financial firm, the liabilities issued by the commercial firm, these are the assets held by the financial firm. And then the liabilities that are issued by the financial firm are debt claims or notes, and then equity claims. And so you could have a share of stock in a financial firm, or you could have a limited partnership stake in a financial firm. Okay, so real assets versus financial assets. Let's move to the next topic, which is the total size of the stock market. So the stock market is the present value of all future profits of most of the goods and services produced in the economy. Remember, private companies are not part of the stock market. And the biggest factors in this present value are growth rates and discount rates, and we'll spend more time talking about that. The market capitalization of the stock market is about $35.5 trillion. Remember, this is shares outstanding times price per share, the sum across all companies, and so we get about $35.5 trillion. Well, how about the bond markets? How big are the bond markets? Well, we have these sort of 5 sectors. We have Treasury and agencies of the U.S. government bonds. We have mortgage bonds. These are bonds backed by individual mortgages. We have corporate bonds, bonds that have been issued by corporations. We have municipal bonds. These are bonds that were issued by state and local governments and authorities. And then we have asset-backed bonds. And these are bonds that are backed by corporate loans and consumer loans and other specific assets that were essentially loans made by banks. The loans are then packaged, then the bonds are issued. So here, just look at the size of the stock markets and the bond markets, and you can see the orange line is bonds and the blue side is stocks. And you can see what's happened over the last 10 years. The stock market was roughly half the size of the bond market. The bond market has continued to grow, but you can see not at the same rate as the stock market. So now they are much, much, much closer in terms of value. But, and this is very important, the bond market is much, much larger than the stock market at about $45 trillion versus $35.5 trillion. This is a breakdown of the orange line. So this is a breakdown of the total size of the bond markets. You can see that within these sectors, you can see that Treasury and agency bonds represent a significant portion of the total amount of debt outstanding. You can see the orange line is mortgage-backed, the gray is corporate, the yellow are munis, and then we have asset-backed bonds, and we have money market type securities and money market bonds. And so you can see a significant portion of this market is actually Treasury and agency debt. The next thing to talk about is trading volume. How much trading actually goes on in these different markets? The stock market versus the Treasury bond market versus the corporate bond market versus the municipal bond market. First thing we have to do is just talk very, very quickly about how the Treasury bond market works. So the U.S. Treasury issues securities to finance the annual deficit and the accumulation of these annual deficits, the U.S. debt. And it chooses maturities to issue, and it issues them essentially 4 times a year. And it's going to issue 2-year bonds, and 3-year bonds, and 5-year bonds, and 7-year bonds, 10-year bonds, and 30-year bonds. 2s, 3s, 5s, 7s, 10s, and 30s. So 6 different bonds. The most recently issued bond of any maturity is referred to as the on-the-run bond. And it replaces a bond which is just a few months old. When this new bond is issued, this is the bond which receives all of the trading volume. So the most recently issued 10-year bond is the bellwether 10-year bond. Anybody who's interested in speculating and trading a bond with a 10-year maturity is going to trade the most recently issued or the on-the-run 10-year treasury. There is a 3-month-old 10-year bond, which is now a 9 3/4-year bond, and this bond has significantly less volume. People just don't trade that anymore. And there's a 6-month-old 9.5-year bond, the 6-month-old 10-year bond. People don't trade that either. And so the most recently issued bond of any maturity, treasury bond, is referred to as the on-the-run bond, and this is the bond that's going to receive all the trading volume. So we're going to scroll down, and this is a chart I took from SIFMA. SIFMA stands for the Securities Industry and Financial Markets Association, and we'll play around with that website. And what this is the average daily trading volume in U.S. capital markets. And unfortunately, they stopped putting together this table and they stopped producing the data in such a clean way. So we're going to go back and we'll look at some stuff that's a little bit old. This is the 4th quarter from 2018, but the trends are relatively similar. And what we're going to look at here is the amount of total trading volume for U.S. equities. This is the dark green. The amount of total trading volume for all corporate bonds. This is the light green. We're going to look at the amount of trading volume for mortgage-related bonds, for treasury bonds, and then this tiny sliver up top is municipal securities. And so what we're looking at is the total dollar volume traded of all these things. This is about 5,000 stocks that are trading in this dark green line here. This is about 20,000 corporate bonds that are trading in this light green line here. This is sort of a large number of mortgage-related bonds. Tough to sort of how many there are, but the key to this is this light blue section here, which is the largest portion of average daily trading volume in dollar value. This is 6 treasury bonds. 6 treasury bonds, 5,000 stocks, 20,000 corporate bonds, and probably around 100,000 muni bonds. And so the point is that look how much trading volume there is for 6 bonds. The takeaway from this chart is that U.S. Treasury bonds, these on-the-run bonds, these are the most liquid assets in the world. Another interesting chart we want to look at here is new issuance of bonds, far more than stocks, because stocks don't go away. Bonds go away and have to be reissued. And so not only do bonds trade more than stocks, but there's also a lot more issuance of stocks than bonds.